Welcome to Leaders in Lending. I'm your host, Jeff Keltner. Today I'm speaking with Barry Roach, the President and CEO of Water and Power Community Credit Union, based here in my home region of Los Angeles. It's the first time I've spoken with a credit union executive, and I really enjoyed this conversation. We talked a lot about the value of trust and loyalty that comes with being a community-based institution. We talked about the need for financial literacy and education, helping consumers understand the right products and find the products that meet their needs, how that led Barry and the credit union to really continue investing in their unsecured lending platform. And we also talk about how to make sure you're adding value and driving value for all your consumers and all of your products. It's a really interesting conversation, and I hope you enjoy it. Barry, thanks so much for joining us today. I really appreciate it.
Thanks, Jeff. Great to be here.
Yeah, I think you are the first credit union executive to join the podcast. I hope not the last. I know we've got a few more we're talking to. But I kind of wanted to start off with your perspective. I know you've been in the banking world and you're not a credit union. How do you think about how credit unions versus banks and kind of what makes credit unions and their space in the financial services sector a bit unique?
Sure. Great question. Thanks, Jeff. So my career, I started in banking in Canada, moved down to credit unions in the United States about 15 years ago or so. So seeing the different perspectives. Credit unions really have a special place, especially in community-based, as a community-based organization. I think that credit unions will always have some sort of an affiliation with certain people in the community. Here, see, this is Jeff. This is where I need to be edited, right? So I'm going to start over again. We can sort of go from here.
Yeah, we'll chop it up.
Yeah, we'll chop that up. Okay, so I think there will always be a need for credit unions in communities. There are certain people in communities who see an affiliation with credit unions, whether it be someone that they're employed with, or it's an institution which they have some sort of an affinity with. But I think ultimately, credit unions really truly understand the unique financial needs of those in their particular communities, more so than some of the larger institutions. And there's a place for everyone. I think it's a pretty big spectrum of financial services and a pretty big market that we're all in. But credit unions certainly have and will always have, I think, a place in that market.
Yeah, they certainly have a special place in my heart. My first bank account was at a credit union associated with my university. So
Is that right?
that's kind of, that's how I entered into the financial services sector, was with a credit card and a bank account or a DDA, I'll say, at a credit union. So,
Right. So just
one of the things,
curious, why that? Why not one of the larger institutions? Because that seems to be sort of the natural place. You see it advertised, right?
Well, I think for me, it was just being on campus. It was a campus oriented. There was the branch was in the student union, and I needed something, and it felt convenient and close, and somebody I could talk to. And this was, I'm not that old, but I'm old enough that this was pre-cell phones and pre-internet banking.
Right.
And didn't watch a lot of TV when I was in college for reasons I don't fully understand. But so I didn't see a lot of advertising. So I think it was just kind of feeling a connection to that community, feeling like there were people there who understood what I needed, and they were kind of set up to help the student community. So it worked out well for me.
So are you still a member there, Jeff?
I'm not still a member there. I've moved on to as I moved around the country, local branches became something that was important to me, and I've ended up moving quite a bit. So
and I think that's what happened. So again, you started with this credit union because you felt that affinity and that connection. And as people sort of move away, they sort of move away from that connection as well, and then realize, oh, well, maybe I have different needs. The reality is, credit unions, like a lot of community-based institutions, and with the proliferation of digital technologies, there's no need for you to really move to another institution. You can still perform your banking transactions from across the country, around the world. It really doesn't matter anymore, right? So that's the trick for credit unions, right? How do we keep those people who started with us in university or started with us as their first job or second job, and then how do we adapt and evolve to their needs as their lifestyle changes, as they move around? Digital technologies, it's funny because 20 years ago, we were sort of begging people to use digital technologies. It's like, hey, we've got this really cool online banking system, and you can pay bills online. And people are like, I don't know. There's skepticism around that. What's happened now? It's completely flipped, right? And now people will not deal with you unless you have a rich and robust digital banking platform, because it doesn't meet their needs. People aren't walking down to branches at 3 o'clock on Friday night to cash a paycheck anymore, or to deposit funds or what have you. I mean, that the whole game has changed. And so community-based institutions, the ones that are thriving, are the ones who really have that platform that is fitting the needs of the evolving needs of their members. Again, as they kind of go through different challenges and different stages of their life.
I hadn't thought about that, but that makes a ton of sense that, for particularly often geographically based communities, people do leave. That's me. If I was in college and then I ended up in, you know, Kansas City and Washington, D.C., and nowhere near California where my credit union was.
Right.
But the digital technology is an opportunity to really bridge that divide. And now calling the bank or going into the branch is kind of like, it's what happens when for me at least, when the digital technology fails. So is that something you guys are really investing in, is saying, hey, this is a real opportunity to bridge the gap for when our members are spreading out or doing something different, we can actually meet them where they are in a way that just wasn't possible 15 or 20 years ago.
No, that's right. And definitely, you nailed it earlier. You said not only that you had an affinity with this particular credit union, but it was close. And you went in for advice because really, as a 17 or 18-year-old student, you didn't know much about banking at all. We still have most of our new members come in today through our branch network. I wouldn't say most, but there's still a pretty large proportion that still come in through our branches. Now, they're not coming into our branches to do transactions afterwards. That's got to be done digitally because that's really what consumers are looking for right now. But they're coming into us for that advice originally. What is the right type of transaction account I should have, or show me the differences with credit cards, or even explain credit for me, because a lot of financial consumers, especially younger ones, they're not teaching it in school. They're not getting it in their advanced degrees. They may pick up stuff if they read blogs or they watch or listen to podcasts or what have you. But they're coming in because they've got genuine questions about building credit, about buying their first car, buying their first home, and that's why I think, especially for community-based institutions, branches are so important, because there's an accessibility there that I think maybe is lost with some of the digital technologies. Sure, you can do video chats and so on and so forth, but and maybe that will be the technology that will proliferate and be the way that people are going to be consuming that sort of advice. But I think today, especially for the community-based institutions, it is the one grounding we have, that and something. It's a bit of I would say, a competitive advantage in some respects, especially in the communities in which we reside.
How do you think about the purpose and value of branches? You said, like, people they might open an account there, but they're not coming in to transact. Like, I certainly, when I changed my bank account, it was kind of because, like, you had to walk into a branch to deposit a check, or you paid a big ATM fee, and there was no branch. So that was what I had to do to be able to not be paying a bunch of fees.
Sure.
Now today, I would never. I mean, A, I want my direct deposit, not a check, but also B, I would always mobile deposit. But I still think there is value in the branches, and I'm curious, outside of new account opening, where do you see the value that's coming from that branch network and that in-person interaction versus the kind of easy transactions that you can facilitate on a digital device?
Yeah, I mean, great question. And I think what people are walking into our branches for, beyond just that opening that first checking account or first savings account, is that we do have teams of financial professionals in our branches. We've got we have real estate loan professionals. We've got investment professionals that are accredited and licensed and so on. Especially on the investment side. I follow fintech Twitter and blogs and so on, and Reddit and Wall Street Bets and all the Robin Hood stuff that happened in the past 6 months. So it's been fun to watch on the sidelines, right? But again, if you need true investment advice, that's kind of hard for people to find right now from someone you trust. And so I think, again, a credit union, there is an inherent trust in the people that are in that credit union. And so that's why we're still having people come in with these legitimate questions about their financial needs, and we have the capability and the resources to be able to provide those answers for them. We don't want people walking in to make a trade, for example, of a stock, right? Let that be in a more efficient platform. But if they just need to get a start, or they don't really know what they need for retirement, or how to save for retirement, or what options are available for retirement. This is not investment advice, by the way, but but they can come in and see a trusted advisor, and I think that's again kind of the competitive advantage that we have maybe over others today.
Yeah, I think that's a great perspective, and it is amazing you mentioned the kind of lack of education around financial things. It
Yeah.
boggles my mind today how little financial education so many of our consumers have. We see that in just the loan applications. We facilitate people not understanding the difference between an interest rate and an APR, and our fees on top of an APR, or and like these are really fundamental issues if you're looking at different kind of lending and borrowing options, like, and they're just not sophisticated. So I think that assistance in navigating those questions is really critical
Right.
to help people make the right decisions.
Well, I mean, it's complicated. These aren't easy products. We market
Yeah.
them as easy products, and especially fintech. Fintech, I will give fintech credit for really sort of demystifying a lot of financial
Mm,
products out there. They really do make it simple. Upstart, for example, your onboarding platform, you ask questions in a way that are simple for not just financial
mm,
consumers but consumers to understand. When I started in banking a long time ago, a loan application was exactly that. It was a in triplicate application with a whole bunch of little tiny fields that had to be filled out by pen.
yep.
I'm dating myself a little bit, but and those questions were very much central to the financial institution. It was all about what we need, right? The information we
Hmm.
need in order to make a decision. Now, I think a lot of it is really, okay, consumer, what is it you need? And just turning that dialogue around, I think, makes it more digestible and consumable for borrowers today. But going back to financial literacy, we have more resources, Jeff, at our fingertips today for financial literacy than any generation has ever had. Yet there
Hmm.
still seems to be generally a lot of misunderstanding of how financial services works and how financial products work. And so again, community-based institutions, we try and do a lot of education.
Hmm.
We not only educate our members as they walk in through the doors, we've got resources that are available on our website. And from a community perspective, we also try and go out in the community and educate people about what a credit score is, how you build
Hmm.
credit, what things can really harm credit, your credit score, and how you can restore that. In my career, I've done first-time homebuyer seminars. I've done education to high school and middle school kids around budgeting
Hmm.
and things like that. And so at Water and Power Community Credit Union, we're doing many of the same things here within our
Hmm.
community. We're headquartered here close to downtown Los Angeles,
Yeah.
which is not, you think a community-based institution, you may think, okay, small town USA in a rural area, the one bank on the corner across from the
Yeah. Yeah.
hardware store or something. It's not like that anymore, and it really hasn't been for a long time. But our pocket within Los Angeles, the community that we feel we own, is a very sacred and important community to us. So anything we can do to educate those not just members of the credit union, but those members of the
Hmm.
community about financial products and services, we're going to take that opportunity and run with it.
Yeah, I love that connection to the community. When you and I were talking earlier, we started talking about, you know, you're getting into unsecured lending, but I really wanted to step back and say, it feels to me like I've always enjoyed my conversations with credit unions because there's a real focus on consumers and consumer lending in a way that many banks don't have. Consumer lending is often only mortgages or maybe credit cards, but it's pretty limited, frankly, at many institutions. And I think credit unions have been on the forefront of being a little more open to consumer lending, slightly riskier products, and really meeting consumers' needs. But you and I were talking about the areas where credit unions and banks both have not been meeting the needs of consumers, where there are things that they want that are not easy to get. So I'd love for you to talk a little bit about like what you see as those gaps, the things driving the new kinds of lending, and then how you think about the credit union fitting into that evolving world.
Sure. I mean, there's been, like, not just lending, but all banking products and services, there's
Yeah.
been a true commoditization of them over the years. There's not much difference between my checking account and the one down the street and the one across the road. They're very similar in how they act, in the fee structure. There's always little nuances here and there. It's
It's
really,
yeah.
really hard to find what we used to call the silver bullet solution. They don't really exist anymore. And I think what fintech has done is come in and tried to find those silver bullet solutions, and in some cases they have. And I think unsecured personal lending is one of those. Honestly, again, going back to when I started my career, there was real stigma around an unsecured personal
Yeah.
loan. It was like, wow, Jeff, you need an unsecured personal loan. You need to consolidate. You've got more than two credit cards, or it was just it was seen
Yeah.
at least in the institutions that I worked in. It almost seemed like it was a last resort. Oh, we better be
Mm.
really careful in underwriting this loan because boy, this guy already got into
Mm.
multiple credit cards or unsecured types of lending. Now we're having to consolidate. That was kind of seen as one step away from maybe something really tragic happening in your personal
Mm.
financial life, and that stigma's gone now. I think because what fintech in general understood is that is a legitimate financial need, and just because people have that financial need is not indicative of their credit worthiness. And
Mm.
that statement alone was something that I think was heretical to bankers in the 90s, even in the 2000s and 2010s, and especially as we go through waves of recessions and so on, banks and credit unions, the risk we would take tended to uh, directly correlate with the time since the last recession, right? So,
Mm-hmm.
we had a pretty bad recession in the early 90s, and lending tightened up and then loosened. And then, we had the run up into 2000 and then a
Yep.
recession, and it tightened. And then 2008, which the world almost imploded, I should say, for
Yeah,
financial
that's right.
perspective. And we all got tight, okay? So now, and what's gratifying to see is even though we had a very short recession post COVID, I didn't really see any change in risk appetite
Mm.
for at least within my industry, perhaps in banks and we saw this week Wells Fargo pulling back from personal lines of credit, right?
Unsecured lines of credit. Yeah.
Right. So that to me that's Wells Fargo. Good for them. That's their conscious risk-based
Mm-hmm.
decision to exit that product. What an opportunity for us, community-based financial institutions, and an opportunity for fintech
Mm.
to have that unmet need, to have a solution for that unmet need. It's just because Wells Fargo did away with that product doesn't mean that need doesn't exist anymore. That need is
Yeah.
still out there, right? Someone will soak it up. Those that have the wherewithal and the ability to do it will find those people, and we'll have a product for them.
Yeah, I love that. I do see it's interesting. We've talked a lot about credit cards because, to your point, a lot of unsecured loans end up refinancing credit cards. But I increasingly also see, and I'm curious your thoughts on this, moving beyond that. Well, I'll say ahead of it in some ways, which is to say, credit card debt's always accumulated somewhere. And
Right.
credit cards typically are what I always describe as a great transaction medium, but a pretty bad borrowing medium for anything but a very short term loan.
Right.
And so whether it's the buy now pay later or large purchase financing with longer term unsecured installment loans, I do think this sense that people are trying to be smarter about how they borrow and be intentional about how they borrow is really driving that. And that feels like a real opportunity for institutions oriented around trust and helping consumers make smart financial decisions and not just simplifying the facilitation of the transaction, but really
Right.
ultimately, again, if you're revolving on a credit card for months at a time, like it's a very expensive way to borrow money outside of a couple of weeks. It's not a great way to do that. And I think that's a real opportunity for people to come in and say, hey, you needed a loan. let's
Right.
help you. Let's help you get that thing that you need and build trust and kind of help you in your financial journey.
Right, because paying down that credit card balance, it feels like the never ever plan. As you
Mm.
pay some down, there's more interest in it. Just, it's two steps forward and one back, but it can take forever to pay that down. Getting an unsecured personal loan to pay it down immediately, usually at a lower rate, is a far better financial
We hope.
decision. Maybe even
Yeah.
better than the decision to not make that purchase in the first place. But that's another story.
Yep.
You talked about pay later programs,
Mm-hmm.
which any consumer of on the internet sees these now. PayPal offers them, Affirm. There's a few others out there
Mm-hmm.
that I just got a new Wi-Fi network at home. It was $600 instead of paying 600 right up front. This is on Amazon. They said we'll do
Yep.
4 payments of 150. Okay, why not, right? Out of my debit card, so hey, I'll never pay any interest off it. But
Mm-hmm.
so that was a personal financial decision I made that just made sense for me at the time. I think a
Yeah.
lot of consumers are seeing that now. Now, what does that do? That erodes that opportunity for us to get that unsecured personal loan or to carry those credit card balances. Because
Mm-hmm.
the dirty secret of credit cards, at least in institutions, is we do like and we want people to to use those credit cards and then pay those balances because they're not earning interest. As an issuer of those, though, they're not paying interest. So there's an income aspect there, right? So
Yeah,
I
yeah.
see both sides, but both as a leader in financial services and as a financial services consumer, right? So I do see these new, I'd say a nuance in payments, sort of changing the landscape for financial consumers and for institutions down the road, because that's going to be less opportunities for us as a financial institution to offer that
Yeah.
sort of unsecured loan.
Yeah, it seems to me though that you can't consumers if any shift is real to me in the last 15 years, have gained the upper hand in these kind of relationships with larger institutions. So it feels like I don't know, you got to be meeting the consumer's need because they're in the driver's seat more than they were 10 or 15 years ago, right? They've got options, they've got comparisons. So it feels to me like the winning play is like figure out what's the best thing for the consumer and offer it to them and see how you make money. Because
Right.
if you're not doing that, somebody else will, and consumers are
Absolutely.
increasingly able to find whatever option makes the most sense for them will be made available to them in one way, shape, or form.
We have more access to financial services and products than at any
Totally.
time in our history. And I'll say the same thing again next year and the year after and the year after. It keeps growing and growing and growing, right? And that's
Yeah.
good for consumers because there's choices, right? It used to be, especially in small towns, because I grew up in a small town, there were very few banks and credit unions available. If you didn't like the service from Bank A, you may have gone across to Bank B and Bank C. That's it. Now, if you don't like that, there are literally thousands of lenders out there, or banks or credit unions or fintech that can meet that need that you have. So, we all, I think from an industry perspective, it also keeps us somewhat honest. Those players who may have taken opportunities around pricing or may have taken opportunities around
Mm.
credit underwriting standards and so on. I'm not saying you compromise those things in the future, but you really have to be pensive about this and and
Mm.
and not just look at it from a pure financial perspective, because it could erode any of the goodwill you have with your existing membership or customers, or your prospective consumers that may be coming to you as well. So it's
Hmm.
the landscape has completely changed for us as originators of loans. But I think, as you said before, even more so for consumers.
Yeah, no, I totally agree. So I wanted to ask you this because in our earlier conversation, we talked a little bit about earning loyalty in the digital age and how you think about the value of that, um, different consumers and the value of them maintaining or growing relationships. I'd love to kind of get your thoughts on this 'cause I think it's a really interesting question. I've sometimes said loyalty used to be about real estate, right? Loyalty was like the closest branch. That's clearly not there now. But how do you think about the way you maintain loyalty and the value of loyalty to your institution?
I think a lot of it, Jeff, is as long as you're showing value back to that person, and value is different for you than it is for
Hmm.
someone else, right? It maybe is a unique thing to that financial consumer, but as long as that financial consumer feels that they're getting value from their relationship with you, then they're going to continue with you, and that could be if they're walking into your branch, or if they're calling you with a question, or if they're interacting with you digitally.
Hmm.
Or look at it this way: if you don't have a rich enough digital platform, and that's not meeting the needs of that financial consumer, there's a good chance they're going to find it from somewhere else, and they're going to find it easily. Um,
Hmm.
I use the term value. It's such a hard thing to sort of pin down. So we almost have to cover all of our bases. We have to make sure that
Hmm.
we're providing value for those transaction needs you have, the payment needs, the borrowing needs, the advice needs, the investment needs, whatever it is. We've got to make sure that we have a good enough value proposition that you're not just going to want to come and deal with us. You're going to want to stay with us, and that we can continue to uh, to provide that value as your level of sophistication, or the level of sophistication of your need changes. Um,
Hmm.
because the retirement needs of a 21-year-old are different from the retirement needs of a 61-year-old.
Hmm.
The 61-year-old is going to need a different type of advice, right? And
Yep,
maybe even a different suite of products than the
for sure.
21-year-old. They're both equally important, but I think it's a different method in which we're going to fulfill that value proposition for each of those individuals. And that's our challenge: is how do we do that? It's not trying to be all things to all people,
Hmm.
but in a way it is, as it relates to their unique financial needs.
How do you think, like, so maybe this is a hard question and you won't have a great answer, but how do you think about evaluating how you're doing and where your weaknesses are in terms of adding value, whether it's product oriented or consumer segment oriented? Is there like a framework you have for evaluating how you're doing on that metrics? I think it's a great metric. Am I adding value to this consumer in this
Yeah.
transaction? But it's also, to your point, like it's a very broad question and set of needs. How do you think about defining where you're doing well, where you're not, where maybe you need to make an investment, like a new product line or a new capability? I'm just curious how you think through that challenge, because it's a non-trivial challenge.
Definitely. And you're talking about a qualitative measurement, trying to quantify a qualitative measurement, which, as
Hmm.
we all know, is difficult to do. So I can't say there's no sort of one magic number that we use to look at, but we do look at it not just from a product perspective, but from a channel perspective, and then from a segment perspective as well. So
Mm.
looking at, as the illustration I had before, the 21-year-old's financial needs versus the 61
Hmm.
retirement needs, I should say. We have to look at that from a product perspective. So how about the suite of investment products? Is it really meeting the needs of both of that cohort? We look at it from a channel perspective, because the 21-year-old may be dealing more from a digital perspective, whereas the 61-year-old may be coming into
Hmm.
to visit with us a little more, right? That's typically kind of how we see. Um,
Yep.
and versus the segment perspective. So we have a whole segment of 21-year-olds and a whole segment. So they all have sort of different measurements. And you really have to, I guess the magic of your analytics department is, how do you take all of those data points and turn it
Yeah.
into consumable and coherent information that can be used to inform your decisions. We're trying to use data more and more, as we all have, but it's almost like shoveling snow for any of you who grew up in the north or in the east, and
Hmm.
you can, when you're shoveling during a snowstorm,
Yep.
that there's more data going in than there is
Coming
data
in then.
going out, sort of thing, right? So and that's what's happened. There's more and more data points now that we can use, and we'll be able. It helps us to refine uh, what those measurements should be. But it's also a little bit of a moving target, right? Just when we think that we may have good measurements around how to quantify
Hmm.
value, the data is changing, and the amount of data is changing, and the data points themselves are changing and getting more and more precise.
Hmm.
So it's one of those things where we will never finish shoveling snow, I think, because it's never going to stop snowing from a data
Yep.
perspective. But we either got to get a better shovel or more shovelers,
A little
and
bit of
that's kind
both.
of the approach that we take to it.
Yeah, I think it's a really interesting insight that like the ability to make sense of data in some ways becomes a value add limiting factor, the thing that limits your ability to understand how you're doing, where you're doing better, how you improve.
Right.
Um, how do you guys think about investing that? I'm curious if you think of that as a horizontal function that runs across business units and products, and something where you're kind of saying, hey, I need to have a universal view. And if there's any kind of investments or strategies you take to say, hey, we need to be able to look across, or if you think of that more in in investments like a product oriented or a segment oriented, because it's
Yeah.
kind of different approaches. But it seems like from your description, something that's going to be really critical to the ability to succeed in the future is doing this well,
Oh,
and being able
definitely.
to make sense of the data.
Yeah, I mean, the platform I think is horizontal, Jeff, right?
Hmm.
But the product owners or the channel owners are going to have their own unique data points that they're going to want to look
Hmm.
at from a measurement perspective, right? At Upstart, like many fintechs, I mean, you've got teams of data scientists who daily are looking at not just the data that you've got, but data that you could get, and what that means. And I know a little bit from dealing with Upstart about the algorithm you use for underwriting, and
Hmm.
it's using machine learning, which is perfect because machines can learn at a faster, more rapid, and probably in a more, I don't want to say intelligent, but in a more structured manner than the old credit guys like I am.
Yeah.
How I learned to underwrite is entirely different from how modern credit underwriting is done, and it's probably a good thing because humans have bias, and humans have. We all have our own
Yep.
unique judgment. Machines sort of take the emotion out of it and look purely at the data. So it's more efficient. You can prove that efficiency with data as
Hmm.
well, And with machine learning, it is constantly refining that algorithm, is constantly trying to find a better way of either reducing risk or increasing profit, or whatever the case may be.
Mm-hmm.
I kind of see the same thing on a much smaller scale with data for us, right? So
Mm-hmm.
use that platform that goes across all products and channels, but each channel manager, each product manager can get really defined into the data that is going to give them the right sort of answers back in order to inform them on what innovations need to be made in that product or in that channel, um, or if there's a profitability thing, or from a risk management perspective. Really, data science kind of blows my mind, and it should blow everyone's mind, because it is really infinite, right? If you really think of it,
Yeah.
there are infinite number of data points that we could potentially be using. It's a finite number right now for what we have, but when you really sort of dream about this,
Mm-hmm.
the sky's the limit. And I love that fintech is really pushing that envelope and making community-based institutions realize that we can no longer just get by on intuition and experience.
Mm-hmm.
We've got to use data to inform those decisions as we make these critical decisions for our business going forward.
How do you think about it in that context where you mentioned we partnered together, and Upstart's kind of providing some underwriting capabilities based on the data sets we have. How do you think about where you're building in-house capabilities, where maybe you look to partner and augment with people who are outside? Because I feel like the question I get from a lot of financial institutions is like build, buy, partner. How do I approach it? So I'm curious if you've got a rubric or a framework for how you think about a build versus buy versus partner. Because there's
Yeah.
there's things I think you got to keep in house. There's things you probably can't compete with what's available in the market. And I'm curious how you
Right.
think about that challenge.
Right. Well, let's talk about unsecured personal lending, right? So we've been unsecured personal lenders for a long time. We continue to be. And
Mm-hmm.
I think, and I look at the measurement, we're pretty good at it. In fact, it's one of the products that when I look at our entire suite, is one of the most profitable, is one of the most used by our
Mm-hmm.
membership. So you talk about value. I mean, just from those two elements alone, I see that we're providing value to the people that are looking for that particular product. So you
Mm-hmm.
go, well, why would we partner with a fintech for something we're already good at? Well, I think the reason is I understand that the data points we have are limited. I understand that the intelligence, the collective
Mm-hmm.
intelligence we have, the humans and the systems that we have, are not as robust as what a fintech would have. You guys have been in this business now for about 10 years or so,
Mm-hmm.
because these thoughts were germinating before you even had a product ready to go to market, right? So
That's
I
very true.
know that you and your leadership team have been thinking of this for a long time, and you've got the programming talent and you've got the systems to be able to not just have this product with great value right now, but one that will continue to have great value, because that is something that you're always trying to do is, okay, this is
Yep.
personal lending in 2000, unsecured personal lending in 2021. What's it going to look like next year and the year after and the year after? And you've got systems that will be able to continue to innovate. Um,
Mm-hmm.
that is an investment that we could make. I don't know if we would ever be able to catch up with you, let alone pass you. And so I think there's no rubric around this, Jeff. But I think it's just our notion of, does this make sense to invest in more systems and technology and intelligence for something we're good at right now, or do we want to augment some other part of our business where we feel that there's the potential for greater value to be added, whether that's building more branches, whether it's adding more staff, or developing our staff so they've got more competencies and more licensing and so on and so
Mm-hmm.
forth. So we all have scarce resources, especially community-based institutions, and especially in a low-rate environment where it's really hard for traditional lenders to make a lot of money right now. Um,
Mm-hmm.
so with those scarce resources, we've got to be really careful about how we use them. If I don't need to spend a penny on trying to innovate, say, an unsecured lending underwriting platform, and I can partner with fintech, that to me is today the best solution that we could go with.
Got it. So we talked a lot about data. Are there other areas of technology that have you excited or curious or kind of, poking around going, hey, this is something that I got to figure out how to bring into the institution? I mean, I feel like ML and AI is on everybody's list of like, it's going to do something and I got to figure out where it fits and how it provides value. Are there other
Totally.
things in that category you're looking at for the future, or does the primary one?
Yeah, no, I think machine learning and AI, and we're not even close to where we need to be on something like that. We're
Mm,
still trying to make sure our platform is developed in a way that we could actually get the right amount of data at the right time,
yep.
to be able to feed into some sort of a machine learning program or AI. The good thing with AI is that there's some rote processes that we've had in financial services, banks and credit unions for years that AI can do sort of more efficiently, maybe faster, cheaper, as the case may be. And this isn't about, okay, well, if I could automate some processes, then I don't need processors. I want to take those processors who truly understand the ethos of our credit union and the
Mm,
community that we serve, and turn them into people that are going to be serving the members of our community, whether
yeah.
they are working in branches or having some sort of direct contact or building products and services that our
Mm,
community needs. Um, so I think the notion for AI machine learning is a lot about workforce reduction. It's not that at all. I see it as really workforce transformation. And
yeah.
having started my career as a teller on the front line, that's kind of never left me. That we need to. I don't care how much technology is out there, Jeff. At some point, you may need to speak to someone directly, and
Yeah.
that person you speak to, there's an inherent trust, but that trust has got to be backed up with that you've got the right amount of advice, that you've got the right amount of information at hand. And so the more that we can take people away from sitting at their desks with head down doing work, more sitting up and face to face and eye to eye with our members, I think that's an excellent trade-off, not just for us, but for any community-based institution.
Yeah, that's a concept I've heard a couple times now that I think makes a ton of sense. Moving kind of staff from administrative processing type work to real value add customer facing type work, which is
Right.
not only better for you, but frankly, I think the staff is happier doing that. It's a
Right.
more fulfilling kind of engagement.
Right. I mean, look, there's still lives in our branches, I'll be honest, right? As there are
Yep.
for other community-based institutions. So, that tells me there's still people that want to come in. There's still demand for that. And maybe we don't have as much staff as we need or as much trained staff as
Mm,
we need to handle all those needs at all those times, right?
mm-hmm.
And technology can also help you figure out when those times of demand are, by the way. But yeah,
Oh
so
yeah.
I think that's something that increasingly we're trying to do more and more in our credit union. And I know a lot of my cohort, at least around California, that I talk to, are trying to do much the same thing.
Excellent. Was there anything I forgot to ask her, or you wish I'd asked during this conversation, or did I?
No, no, I
All
think this
right,
was
we did a
good.
good job in preparation. I like that. It's always a good job.
I like the
Well
interviewing
prepared.
you part. That was my favorite part. So,
I always
um,
enjoy when people flip it around a little bit. It keeps me on my toes.
well,
Well,
no,
Barry,
because really, I mean, we didn't talk about this, but you laid that out really nicely. That hey, I joined a credit union. It's like perfect, right? There's my answer. Well, why? Why'd you make that choice? Or why aren't you there now, Jeff? Like
yeah,
that
yeah.
really interests me because I started with a large bank, 1,200 branches across the country, and five big banks in Canada at the time. By the way, there's a few
Hmm.
more now, but it was really like, well, okay, if you don't deal with us, you're dealing with one of the other four, and it almost seemed like a right. When I think of our thinking at the time,
Yeah.
um, well, we have the right for you to deal with us because it's not a monopoly, but it almost felt like a near monopoly, right? Community-based institutions weren't something that were on anyone's radar at the time. In the United States, and especially now, it's completely different, right? Everyone has a choice. Everyone,
Mm.
and that choice is easy for you to make and easy to fulfill.
Yeah, absolutely. I'm glad I set that. I did not intend to set that up,
Yeah, it
but
worked.
you're
Yeah,
welcome. It worked out well.
yeah.
So I've got three questions that I always end the podcast with in kind of a rapid fire mode. So I don't know if you read these in advance. I sent them to you, but if not, good
I
luck.
did, but I may not have remembered them, so we'll see. Is
But
this like
here we go.
Jeopardy? Do I have to answer like in the
It's
form of a
lightning.
question?
That's right.
Okay.
I'll make the music. Doo, doo. Really. What's the single best piece of career advice you've ever gotten?
Boy, never forget where you came from.
Hmm. And who gave you that advice? Where does that
My
advice come
father
from?
actually. So I come from a family of bankers. My father was a bank manager. My father actually quit 12th grade early so he could work for the bank in his small fishing town in eastern Canada. Now he went back and got the high school degree.
Got his
This
high
was
school
in
degree.
1959. This was, and
Mm-hmm.
once he started that job, that was it. That was his career. So we moved around a lot when I was a kid, every
Mm-hmm.
couple of years, because he was on the fast track, and it was all branch based, right? Um,
Mm-hmm.
so I come from a legacy of being in small communities where the banker, who was a kind of a big deal at the time, I guess, in some of these communities, helped thousands of people literally with getting their first home or helping them with their business needs or
Mm-hmm.
things like that. And but my father, and he attained some great heights in his career. He never forgot where he came from. He came from a small fishing village, and in some respects, maybe he didn't want to go back to that fishing village,
Yep.
and always tried to attain something a little bit greater in his career, but never forgot sort of those small town values, and I think
Small
he
town.
imparted that on me. Yeah.
I like that. So, second question: what's the best piece of advice you've gotten around consumer lending or consumer banking, separate from general career advice?
Uh, Make sure that what you're doing is I'm trying to find a sort of an efficient way of saying this, but really make sure whatever it is, whatever product or service you have is consumable, is something that people really want.
Mm.
Because I've been on the product development side and have put some products out there that we all in a room thought, wow, everyone's going to love this. And it just sank like a stone. And then you scratch your head and you wonder why. And the reality is we weren't thinking of it from the consumer perspective. So consumer
Yeah.
centricity, we talk member centricity.
Mm-hmm.
One of our taglines is human-centered banking, and it truly is about that, Jeff. That if we're trying to create a product that's not really going to meet the need that consumer has, then why bother? So it's got to start with the consumer and sort of go out from there.
Start with the consumer. That's great advice. That was one of Google's mantras all the time. Was always focus on what the user needs, and
Right,
everything flows from that.
right.
And my last question: you have a bold prediction for the future. It can be banking, lending, anything you like. But I like to. This give me a reason to bring you back and hold your feet to the fire, whether they're accurate or not.
Well, consolidation will continue. 25, 30 years ago, don't quote me on the numbers, but there were 20,000 banks and 20,000 credit unions in the United
It's about
States.
right. Yeah.
And now there's about 5,000 banks and 5,000 credit unions. Consolidation will continue. If I could have a 1A to that prediction, partnership with fintech will continue. As a community-based institution, when the word fintech first came out, we all
Mm-hmm.
thought, okay, these are college kids with ideas. This will turn into nothing, and then it's turned into these massive companies with really good value propositions that are meeting an unmet financial need. I think that all community-based institutions and a lot of banks, larger banks as well, need to look for partnership opportunities and not look
Mm-hmm.
at fintech as a direct competitor, even though they are. Um, but I think it's easier to join with fintech than it is to try and outsmart or outwit or outspend.
Mm-hmm.
We have legacy financial businesses here that we have to protect. Fintech has all kinds of great ideas and tons of abundant capital and can take all kinds of risks. We can't take those same sorts of risks,
Mm-hmm.
but I can from afar watch those risks being taken, see the ones that are actually working or have some promise, and
Mm-hmm.
partner with them, and that will give better value to our credit union and to the members that we serve.
I like this. Certainly, our belief as well that the partnership between community institutions and banks and fintechs can ultimately provide the best service to consumers, and that's ought to be the true north star for all of us.
Right, right. Fully agreed.
Well, Barry, thanks so much for joining me. This was a great conversation. I really enjoyed it, and I
Thank you,
appreciate
Jeff.
you taking the time.
Thank you, Jeff. Much appreciated.